Hey, John, thanks for coming on and being my guest today.
No, thanks for having me. This is exciting.
Yeah, I mean, you've been on this podcast a couple of times, I think, so far. This is maybe your first or second video one. I'm not sure, but it's always good to see your face. So thanks again. Today's topic is going to be about how do you buy a home when you're self-employed? More that how do you get a loan, basically, when you're self-employed? Because if you're self-employed, you want to buy a house in cash, good on you. Then you don't need to listen to this episode. But if you're looking to get a loan, it's a little bit more complicated than if you're just, a regular employee who gets a pay stub every 2 weeks. And so we want to go through that so that people can really understand what that process is like, but also covering how things have changed a bit with the pandemic, because I would say for better or for worse, but maybe a little bit for worse. Things have changed a tad, and we want to make sure people kind of understand what they're getting into. So thanks again. Maybe you can do is just start off by telling everybody kind of how the typical process goes. Like somebody wants a loan, 1099, or not, like kind of, and they come to you. What does that process look like? What happens?
Yeah. So, as time moves on, it gets easier and easier for most people, if we want to label them as regular people that get pay stubs on a frequent basis. So with all the technology that's out there, in many cases, we can just take someone's social security number and birth date and, believe it or not, put it in the system, hit a button, and have a snapshot of all the income right there and validate it instantly. So it can actually be that simple. But for most people, it might be getting one pay stub or two pay stubs, your W-2s from your last 2 years, maybe tax returns under certain situations. And then I think, you mentioned the pandemic and kind of how things evolve. And I would say during the peak of it, when the uncertainty was, are all these people going to keep their jobs, right? Are those employers going to continue paying them? They just came up with little restrictions that said, we need to make sure all the way up to about the day you close that you're still getting paid, or that your employer still has you employed, right? So if the whole idea behind loaning people money is the idea that they make enough money to afford the payment, then you always have to make sure that that income is there and that it's stable and that it's likely to continue. So again, it could be super simple. It could be name, address, social, birth date, hit a button, and your income's right there. And it's like, wow, you make this much and we need nothing. And then it can go the other direction as well.
Well, as somebody who is technically self-employed, that is not what happens. If and when I mean, luckily I'm not looking to buy anytime soon, I think. But yeah, so let's talk about if somebody is, so I'm, what happens if I came to you, if I was like, you know what, John, I actually want to buy a house. I'm sick of this place. I don't like this black wall behind me. I'm out. Then how are things different?
Yeah. So back to that sort of underlying theme of, are we comfortable that you're making enough money to support the debt, right? So think of the financial crisis. So go back 2008, 9, 10, 11, the world's ending, and people in my position really were to blame for the whole thing, right? Just easy money for anyone with a pulse. It was here, take this loan, you can afford it. If you can't, don't worry, you can just sell it and make money, right? That was why lending was so easy, is everyone sold themselves out of their problems. So of course the world ends, regulation comes. And then 2012, part of the Dodd-Frank regulatory bill, they said, hey, lenders, this is how you need to document income. And if you follow these rules, you're off the hook. If the loan goes bad in the future, you don't even have to worry about it. But if you don't follow those rules and you give someone a loan and it goes to foreclosure, then you're on the hook for up to 10 years of interest. So essentially the person can live in the house interest-free if they saw that you didn't follow the rules. So back to that regular person, you would get a pay stub and a W-2 and maybe a verification that they're still working. And that's about all you would get. So if you think of being self-employed, what documents do you really have to provide? So you have tax returns, right? And that's from last year. You have a profit and loss statement. But is that profit and loss statement just something you jumped on your computer in Excel and in 5 minutes whipped up? I don't know. That's what some lender, yes, right. We have all your bank statements. We can get every single one of your bank statements and we can see all the money coming in and then all the money going out, right? So those are the things that lenders can do. Now, pre-pandemic, what was interesting is we would just get your most recent 1 or 2 years tax returns. And then your income would technically be whatever you paid taxes on. And of course, you and I know a lot of self-employed people. And if we say, hey, what do you make? The next follow-up question is, well, I mean, what I really make is, but on paper, I make this, right? And I get it. The goal is don't pay a lot of tax. And it's, I deal with I'm a self-employed magnet. So, luckily the reason we're talking together is I do a lot of self-employed loans. And I do believe that self-employed people in small business, like they truly are the ones that take all the risk in this country and employ a tremendous amount of people. And I know there's always that, pay your fair share of tax kind of thing. But I think there's a lot of people out there that employ a lot of people that pay a lot of tax, right? But then you look at their tax returns and maybe they're not quite as rich, right? They don't have big W-2s and things like that because they buy a lot of stuff to keep the businesses moving. So old days, we would get your tax return. We would look at the return and say, oh, you made 100,000. And we would use that as your income for 1 full year until you filed your next tax return. So what changed during the pandemic is, if you think about it right now, all the tax returns are 2020.
Right.
But 6 months ago, people didn't have their 2020 tax return. They only had 2019. So in the old world, we would still give you a loan based on 2019's income, 2019's tax returns.
Right.
So what the government agencies wound up saying, Fannie Mae, Freddie Mac, FHA, all the private investors, they're like, wait a minute, we shouldn't really be giving these self-employed people loans in early 2021 using pre-pandemic income, right? Yeah. It's like, that's the real rule. We've always done it that way. But then this thing happened, and what if they made a lot less money? So now is when it starts getting a little messy. I think the one big takeaway, if anyone's self-employed listening to this, is definitely know that there's a lot of options, and definitely know that if you talk to 3 different people, you will probably get 3 wildly different answers based on either how they're trained, how much self-employed business they do, their underwriters do, or their company does. Right. So we have countless people being said, no, you can't do anything. You can't buy till next year. And then they stumble upon us and it's like, wow, you can absolutely buy. Right. So there are some interpretations there.
Yeah. I mean, I didn't say this in the beginning of the episode, but, I have a lender list of people that I suggest for my clients who are looking for lenders. So, you're not the only lender I work with, though you have been a guest several times on the podcast, but you are one of my go-tos for what I have kind of dubbed complicated lending situations. And part of it's because you have been lending for a very long time and you are very comfortable in this realm. And I tend to have a lot of people in my circle who are self-employed, who have their own businesses. More importantly, they have small businesses. And so in the beginning, their excuse me, their numbers can be a little skewed. So go on.
Yeah. So to kind of swing back and sort of get into how things are done today for self-employed. So there is a general understanding or review of who you were in 2020, right? Did you survive? What did you make? A lot of CPAs, they used last year as a time to just dump every expense under the sun, right? The world's showing a loss. We can show one too, right? Load it all up, put everything in there. They call it, in Wall Street, they call it kitchen sink quarters, where they just bring forward a lot of expenses. So that was 2020 for a lot of people. So now, if you're looking at that tax return, a lot of people on paper do not qualify for a single mortgage. So what the industry's starting to do is use bank statements as a method of approving self-employed people. Now, it's not the most attractive rate, right? So if you get a 3% Fannie Mae rate as an example, maybe this bank statement loan is 4.5, right? So not fantastic, but it's very similar to bridge loans. You and I talk oftentimes when we have someone that has a lot of maybe equity in a house and they need that equity to buy another house.
Right.
And they can get this bridge loan. It's this short-term loan. It's a little expensive, but it helps put stuff together. It helps put your family in a better position. It helps you buy this thing you want to buy. And maybe it comes with a small cost over a small window of time, but it allowed stuff to happen, right? Life kind of moved on. And I think that's what those bank statement loans are. It's probably a loan between now and when you file that next tax return where life is great, right? And all of a sudden on paper, everything looks better. So that's one option. Another option I think is just having someone analyze the returns to figure out how much can be added back. So you'll hear, as an example, we had a gentleman that was buying a home in Florida, little second home. His daughter and his family's going to stay down there. He owns 6 different investment properties. He owns 4 different businesses, one of which was shut down last year, right? Just to frame this person.
Sure.
He was under contract for 30 days. He gets a call about 3 days before closing. You're not going to close. Oh, you don't make enough money. And other lender gives us the position and says, oh, he makes $2,000 a month, roughly, is what it turned out to be. Well, in actuality, when we looked at it, we came up with about $8,000 or $9,000 a month. And it was more understanding of taxes, interpretations, adding back certain things that might be one-off losses, getting a CPA involved to help write some letters and provide some clarification. So there was just an example of one really ugly, messy situation with 500 pieces of paper in his file. But, spend 2-3 hours, work with a CPA and an underwriter, you can kind of find traditional financing and make something like that work.
Right.
So I think it's tricky. And I think we're in this window of time between now. So this is December-ish 2021. I think between now and call it May, June 2022, that is going to be the period of time where it's going to be hard for most self-employed people. Not most, but some. And then after that, once they file their 2021 taxes, I think the whole market rebalances for self-employed people. So I think we're just sort of in like peak part of the frustration, confusion. And then I think things will just settle right back down in middle part of next year.
So I have a couple questions. So, the first thing I want to differentiate between is somebody who's, say, a self-employed person who, I'm a contract employee. I do, logo design for people, and they pay me, and I, have a bunch of different clients. And that's all I'm doing. What if I am running, like, say, a restaurant and I'm a 50% owner? Am I self-employed even if I'm getting a paycheck every month? Like how is that viewed? Yeah.
So easiest way to say it is, so there's 2 parts. There is what some people try to hide, and then there's the actual definition. And I want to speak to both because that try to hide part 100% of the time gets caught, and I'll show you and tell you how. So the definition is if you own more than 25% of a company, you are technically self-employed, and that company can still give you a pay stub and a W-2, right? So let's say you own ABC Logo Designs Inc. You get a pay stub and a W-2 from that company. You also happen to be 50 or 100 or 26% owner of that company. So what some people might try to do is say, hey, look, here's a salary and a W-2 for ABC Logo. And they go through the whole loan process. They do not mark that they're self-employed. But there's this report, you'll hear things that's called CoreLogic or Fraud Guard, or there's just a bunch of these different companies. And they pretty much scrape name, address, social, birth date, prior addresses, just a whole bunch of stuff. Think of whatever is on the internet that might have your stuff attached to it, and it scrapes all of it and will come back and say, I think that person might own that company. So, and with most mortgage companies, that doesn't come up until you're about 2 to 3 weeks into the process. So it's sort of like, hey, wink, wink, I'm not self-employed. And then boom, 10 days before closing, they're like, whoa, man, you didn't tell me you own this place. What's this all about? And then you see the tax returns, then you see the loss. And the reason lenders want to see tax returns is depending on tax laws and how things work, you might actually have a positive W-2 and a negative company loss so that you essentially truly make nothing. That sometimes happens. And then the other way, sometimes it's flipped, super small W-2, and you make a whole lot of money in the business. So that's why you always generally have to see both, and why it's really good to just come right out of the gate. I am self-employed. Can we look at it? And then
I think that's
it.
a really important point, because when people are setting up their businesses or when they're working with an accountant, I don't know if they always even know that they want to buy a home, right? So they're not necessarily even thinking about the implications of some of these actions. They could be perfectly legal what they're doing, but it can have a negative impact on when they go to buy a home. So I think, just if anybody gets one major piece of advice out of this, which is just be completely upfront and honest with your lender, because it's a pretty much a guarantee that you guys are going to find out if something is not right along the way, right?
Yeah, you bring up a fantastic. Oh, go ahead. I'm sorry.
No, I was going to say, I mean, like it, and when you said you find out 2-3 weeks into the process, if somebody were to not have checked the box that they're self-employed, then that translates to you not closing. That translates to you or not closing on time. And that means that you're not holding up your end of the bargain from the contract perspective, which has, other issues and that will come from that. And ultimately, if you're buying a home, you probably want to own that home and you want things to go to plan. So it just, it's best to just be upfront, and we can talk about some tips maybe for people who are starting to plan to buy a home and they are self-employed. We can talk about that in a minute, but yeah, go now. Now you can tell me how wonderful my point was.
Yeah. No. So you brought up an interesting point. So there's a couple of different parts of our practice, right? There's helping people get into a house. There's strategic refinance opportunities when rates drop. And there's also just long-term planning. And we do this thing called an annual mortgage review. And it's a few times a year, someone will say something like, hey, I'm thinking about starting a business. How does that impact my ability to do stuff in the future as far as loans and credit goes? And it made me think of a couple different things. It could be someone that wants to take that risk, feels and knows it's going to be successful, knows they want a new house for their family long term. Sometimes that means bringing forward your decision to purchase when you're technically really easy to get loans. Once you become self-employed, if it's just truly you and your income in that business, it generally takes you being self-employed for one full tax year to get a new loan. So like right now, if you started a business today, right, December 2021, you could technically get a new residential mortgage February, March 23. Right? That's probably the shortest window of time. And the business would have to be successful in 2022. Right.
Right.
That's sort of how you would do it. Other things self-employed people do is just when they have that gangbuster year or two, they just do stuff, right? I have some real estate partners that like yourself that buy properties in years when they're just doing really well. And even when people are like, I don't know, man, do you think it's a good time to buy right now? The market's crazy. They're like, yes, because on paper, I can buy whatever I want right now. And I'm just going to do it because I can, because I qualify and I know loans are easy. And I think that's a really interesting thing for all self-employed people to take away from this is on the good years, you do all the stuff that you want to do. And sometimes you even do the stuff you want to do 2 years from now. Because it's easy. And then people thinking of becoming self-employed, sometimes you pull all that work forward, right? Instead of waiting 2 years to do it, you do it today. Just makes life a whole lot easier.
Okay. So to that point, offline, you and I were talking about things that people can do if they do decide that they want to buy a home and they're self-employed. And we were talking about me as a reference. And I started this new brand this year, The Rare, and I really went hot and heavy into the podcast. Obviously, we're doing video and the whole thing. So I had a really great year, but I also spent a lot of money on getting the business set up and getting everything set up. So my write-offs are pretty considerable this year. So, the difference between my gross and my net is pretty sizable. So, I asked you, and we can talk about this now, if I did want new, I wanted to buy next year, should I be writing things off differently? Maybe paying more taxes, but because that might help me on the back end of, when I want to buy a home. Like, what advice do you have for people who are, trying to figure this stuff out right now?
Yeah. So what I would say is every February, March, April, every self-employed client that I have would generally reach out and say, hey, I'm about to file this return. And I'm just wondering, this year I'm thinking of doing fill in the blank. How will that impact my ability to do whatever? And I think it's very personal, right? Obvious, depending on what you can do, what your CPA allows. But in some cases, we have people that they speak to their CPA and they might defer some of the expenses, like amortize it over several years instead of all at once, right? Like we buy a bunch of office furniture for a new office, but we might amortize it over 10 years. We don't just take that big chunky loss day one, right?
Mm-hmm.
It was part of our cash, and then we just expense it slowly over time. So I think there's a lot of little things like that that people can do to try figuring out, if they need access to credit and it's regulated residential money, which is a little bit more restrictive.
Mm-hmm.
What practices exist? So it's a general conversation that a lot of people have right before they file taxes.
Yeah.
And it's everything from someone buys an HVAC unit for 15, 20 grand on a rental property, and they might think of buying other rental properties, and they want to see if they write it off one way, how will that impact their ability to possibly buy that other investment property? So it's all sort of connected. And I would say that you still have to show some kind of a profit for it to work.
Right.
And a lot of startup years, there is no profit, right? It's truly a drain. Some of the things people will do is, the rules are actually pretty cool now, where if you're not using an actual job that is self-employed and that job is a loss, right? Think of a startup job, other job that has positive income, you can still use. So that there are some flexibilities there where if this other consistent income existed and other income consistent, let's say, would be spouse or partner, co-signers. That's one thing that a lot of people sort of forget about. And it's kind of a weird thing to sort of go, mom, dad, brother, whoever, would you think of helping me buy my place? A lot of times people will look at that, and if their income is stable and they obviously believe in you, your business, and your opportunity, that they'll go on the loan knowing that you'll probably refinance them off in a year and a half.
Mm-hmm.
So that's also something else that I see a lot of people do with good success.
Yeah, I think I've either even talked about it with you directly on another episode, or I know I mentioned it in this podcast before, the whole cosign thing. I think people have, I don't know, it's like they're embarrassed or something, or, there's a pride factor to it. But inherently what we're talking about is a little bit unfair. The fact that people who are self-employed are having this extra layer of scrutiny when they're applying, when somebody who has a regular job, quote, and they could get fired tomorrow, or they could lose their job for whatever, they could leave their job tomorrow. And so it can seem a little bit unfair, and you have to jump through, unfortunately, some hoops. So, having somebody who can co-sign and help you with that. I've said on air before, like my dad co-signed my refi because I took a year off and traveled by myself around the world, which was wonderful, but I had no income. So when I went to refi, it was like I have no job and I had to use him. Did I want to? No, but I also wanted to pay less per month. So, it worked out. But I'm glad you're mentioning it, because I think it's something people should, consider if they're in a position like this.
Mm-hmm.
So,
yeah, for sure. And the key is to think of all of those as short-term endeavors if the business is successful, right? And I agree to your point. There's so many people that we'll give loans to, and they'll call me maybe 2-3 days after closing and be like, hey, if I quit my job, I'm cool, right? But yet that self-employed person who has blood, sweat, tears, equity, hard work, nights, weekends, like, passion, drive to keep doors open and keep it moving forward, we're going to make it really hard for that person for the first couple years. And I just think there's a perception that if someone works for another company, that job is more stable than the self-employed person. And it's almost like the industry saying to self-employed people, prove that you're not risky, right? On paper, by paying tax. And that's sort of the litmus test. Yeah. Now the industry's starting to wake up to that, though. Like what I think they've learned through the pandemic is using tax returns a year and a half old to approve someone's probably not the way to do it. And right now we need to prove revenue. We need to prove the business is still operating. And the way you do that is you get 3 months of recent bank statements and you look at the deposits coming in. And then if you don't have it within 3 months, you can go a little further back. You can show future jobs that you're getting paid on, accounts receivables, all that stuff. And I think we're learning that that's a better way to underwrite people, getting a little more in the moment. If I have someone that made 30,000 last year and they got a raise to 120, we would give that to them. They could have just gotten the raise last week, and we'll say, okay, well, now you make 120, here you go. But Mr. Self-employed person, we've got to go back a year or 2 or 3 or whatever. So I think we're learning as an industry. I think the pandemic's going to teach us a lot of how to be a little bit more creative with self-employed people. I think that's why you're seeing more and more of these bank statement loans come out. And I think as loans come out, know that the first iteration of them is expensive. And then once they see they perform pretty well, the cost comes down, right? So if right now I threw out some 4.5% rate, maybe it's 4 in 3 to 4 months if the market adopts it. So I do think it's going to get a little easier for self-employed people as we move forward.
Okay. Well, I think this is a good place for us to kind of end things. I will just end by saying I think it's really important that people who are self-employed not be discouraged to try to be homeowners. You need to just find somebody. It could be you, it could be another lender who is comfortable working in this realm. And just to know that it might be a little bit of work, but frankly, if you've started your own business, you're probably used to doing some work and you're probably ready to put in work for the things that you want. So, I'd view it that way. But if anybody has any specific questions for you, John, I'm going to link your information in the show notes so that they can reach out to you directly. Of course, people can always reach out to me as well. And I just want to thank you for coming on and giving us so much education about this today.
Yeah, no worries. So one last little thought for everyone that's self-employed specifically. A lot of times when I say if you call someone and you have a conversation and you're not getting the answer that you want, which is yes, you can do this, I usually say if in the industry, generally it's pretty similar across the board. With self-employed people, I say get told no 3 times. And then once you're told no 3 times, maybe that's just what it is right now.
Yeah.
But the first no, just be like, okay, ask one more person. Second no, ask one more person. And just know that you found the right people, because I would say 10% of the loan officers out there are competent with self-employed people, and probably 10% of the underwriters are too, right? So it's a small subset of the entire industry that knows what you look like and what you go through and how you file your taxes.
Well, that was really made me feel good. That was very uplifting way to end it. Have somebody say no 3 times, and then, then you can go cry in your coffee. But hopefully you'll find somebody who will not say no, and they'll help you get through the process. So anyway, thank you again for coming on. Anybody reach out if you have any questions, and we'll see you next time.
Awesome. Thank you.